Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Ever wondered the key to success for Warren Buffett's great fortune? Investing in its true essence is what the Oracle of Omaha, Warren Buffett, captures in the simplest sense through his guidance and own method of investing. Understanding his ideology and implementing the same in your own way can help ace your investing journey too. In this video, we will look at some of Warren Buffett's criteria for identifying an excellent business and delve deep into the Buffetology of sensible investing. The first criteria being a strong brand name or a consumer monopoly. Most of us would have seen those Coca-Cola advertisements on every second street with a famous celebrity drawing our attention to the well-known beverage. Many names such as the Wall Street Journal, Wrigley's and our well-known Coca-Cola can be found in the remotest of locations and have strong customer loyalty. They have what is called a consumer monopoly. Most of these companies have been the first ones in their game, bringing in different innovations that not only attract but also retain the customers. That is why, even with strong competition in the market, their position remains unthreatened owing to their first mover advantage. Just like a toll bridge across a river has a monopoly on crossing in terms of the toll paid by a consumer, most of the renowned companies in their field, such as for newspapers, the Times of India, Hindustan Times, or popular websites such as Amazon or Flipkart, can charge heavy tolls on advertising through their brand name. Another popular example of a toll bridge is CDSL, that facilitates holding of securities for which you have to pay a toll or a charge to buy and sell in the market. The second criteria is consistently increasing earnings. Being a known brand and having a consumer monopoly certainly gives you the edge, but consistency is the key to trust for any investor out there. A company with constantly increasing earnings should be preferred to the one with fluctuating returns. After all, what you want as an investor is more returns, and that too consistently. Suppose we have two companies A and B. From the data, it is evident that company A has a consistent rising trend in profits according to its earnings, whereas company B has a fluctuating return pattern that was seen to rise drastically but showed a sudden downfall in returns. Warren Buffett would certainly go for company A, showing steady returns for the investor. The next factor to be considered while investing in a company is the way in which they finance their expansion and operations. That means they should have low debt/equity. Suppose Coca-Cola wants to get into the cornflakes business and needs funds for the same. It can either borrow money in the form of debt from the bank or sell its shares in the market, i.e. equity. Warren Buffett believes in companies that are conservatively financed in the sense that they have little or no debt. Coca-Cola and Gillette operate on very low debt and are hence considered to be two of the star players of Warren Buffett's investments. Let's talk about the fourth factor, that is high return on equity or ROE. Before understanding why a higher ROE is preferable, let us simplify the concept of shareholders' equity. The shareholders' equity is a company's total assets minus total liabilities, or the amount the shareholders hold in terms of their contribution in the company. In a simpler sense, suppose you buy a house for 50 lakh, you pay for the same through your savings, that is rupees 10 lakh, this becomes your shareholders' equity, the only shareholder being the owner of the house, that is you, and by taking a loan from the bank for 20 lakhs, while this is the debt in terms of the money you borrowed. Now if you put your house on rent and get 1 lakh per year with the household expenses being 50,000, your net returns is going to equal to revenue minus expense, which is 1 lakh minus 50,000, which is equal to 50,000. Your return on equity is equal to the net return upon equity into 100, which will equal to 5% return on equity. The average return on equity for American corporations is at 12%. In the Indian context, ROE of 15% or higher is considered good, and ROE going below this threshold is considered below average. This tells us that buying this house would not be a good investment opportunity, and one needs to consider the ROE before investing. Now let's talk about higher retained earnings or lower dividend payout. Consider having an apple pie all to yourself. Now you could either have the whole thing at once or save some for having it later when you crave it more. This is exactly what Warren Buffett propagates in the form of retaining a higher proportion of earnings of the company, that is retained earnings, and give out a lower share as dividend to its shareholders. Now investors might be apprehensive on the idea of lower dividends at first, but if the company uses this amount for further expansion, then the returns in the long run can surpass the small amounts lost in current dividends. Identifying such companies and understanding their expansion potential can help grow your wealth in the long run. The next factor to consider is low operating and capital expenditures. You'd always want your costs to be low, right? A business with higher profits and lower costs in terms of its operations and expenditures on long-term items, that is capital expenditure, is surely a good bet to consider. An automobile business such as Tata Motors, even while earning profit, would have to spend a large sum of money on capital expenses such as buying new machinery and capital equipment. Whereas a business with low expense and higher customer value, such as the publishing business with operations in limited localities, can gain higher net profits. Hence, investing in companies that make more money, retain that money, and have low operating and capital expenditures are lucrative avenues for profitable investing. Is the management interested in expansions or new business opportunities? This is another factor to consider. Having money is one thing, retaining and growing that money is another. One of Warren Buffett's criteria states that companies that provide higher return on the retained earnings are good investments. He suggests that companies should use their retained earnings for diversification or for investment in what are called cash cows. Well, cash cow does not sound familiar. Let me tell you what cash cows are. These are the businesses that generate huge sums of money without heavy investment and capital expenditure. Examples of these could be in the food and dairy product sector, companies such as Nestle or Kraft Foods. Thus, if the management of the company has a good track record of using its retained earnings well and promises to do so in the future, it's definitely a good opportunity for higher returns in the long run. Can a company readily pass on increase in cost to its customers? Well, this is another factor we will talk about. We know that inflation causes prices to rise. In such a situation, if the company cannot increase the price of its own good, the cost of production increases while revenues remain constant, reducing the bottom line or net income. This situation occurs periodically in the airline business due to heavy fixed costs on purchase of new airplanes, repairs, contracts for pilots, etc. A rather recent and popular example of the same could be the downfall of Vijay Mallya's Kingfisher Airlines. This airline company was unable to increase its price because of competition in the market, while its running costs increased due to an increase in crude oil prices. To provide the same value to its customers, it continued operating on the same cost and borrowed huge sums of money to run its operations. The Vijay Mallya extradition case was not a one-night event and was rather a result of the inability to readily pass on increase in cost to customers. Similarly, some companies can easily and readily pass on increase in cost to its customers. An example of this could be Relaxo Footwear. With an increase in the price of raw material, that is rubber, it can easily increase the price of its footwear as people can never give up on buying footwear. Identifying businesses that provide value to the customer that cannot be foregone in times of increased prices can lead to selection of excellent businesses. The last factor to consider is if the retained earnings increase the intrinsic value or the economic value of the company. Warren Buffett strongly believes that long-term investment of retained earnings can go a long way in terms of increasing the intrinsic value of a company. A very good example of the same is his very own Berkshire Hathaway, which was trading around $5.25 a share in 1981 and shot up rapidly in 16 years to reach $45,000 a share. Increasing the value of the company through efficient use of retained earnings thereby leads to an increase in the market price or the stock price. Understanding Buffett's criteria and implementing the same in your own investment practices can not only help in increasing your wealth, but also gives you a better understanding of how to identify all the great companies out there. With proper knowledge and practice in the investing field, who knows, you might be the next Warren Buffett.